multiple residual income generators. Now, let us examine some passive income generating opportunities. You may use one or a combination of the methods to generate passive income. Investors. Real estate investors get cash flow from rent in addition to capital gain. Savings account owners earn interest. Investors in shares get dividends and appreciation. Discount mortgagers earn interest. Tax lien certificate holders earn interest penalties. Debenture holders earn interest. Businesses. Entrepreneurs who autopilot their businesses earn passive profits. Franchisors get a percentage of gross revenues or profits. Partners get a share of profits. Venture partners get percentages of profits. Royalties. Authors get royalties from their books and tapes. Musicians and songwriters get royalties from their work. Visual artists get royalties from paintings. Inventors get royalties. Game designers get royalties. Actors get a percentage of the profits. Miscellaneous. Company pension plans offer income flow. Retired persons get pensions. Network marketers build residual income through leverage. Corporate managers get stock options. Insurance agents get residual income from their sales. Securities agents get residual sales. Celebrity endorsers get a gross percentage of profits. Mailing list owners get rental fees. The above list is not exhaustive. It is possible to automate virtually any business by putting in systems and delegating authority. It is also possible to franchise businesses for passive income or sell shares to create wealth. There are always some costs involved, but the effort is worth it because what you will create is something more powerful. You will create income streams that do not need your presence. The trick is to let your money work for you and not you working for money. Once you start generating passive income, your money will be working for you night and day, even when you sleep. Investment in residual income. You will need to make a significant initial investment to create a passive income, which can be in terms of money or investment in time. Investing time. Most time investing passive incomes comprise of ideas that will need energy inputs as well. Generally, you will be turning your spare time into some sort of product that will provide a steady stream of income over time. Everyone has some unique knowledge or skill that can be converted into electronic books and sold on the internet to create passive income. The beauty of life is that each one of us has a unique experience that can be shared with others in the form of blogs and books. I have written a few books. These books are working for me as passive income generators. I am simply sharing my experience with others and creating value in their lives. Each book that I write is a new source of passive income for me. Publishing books was a problem earlier on, as only a few big authors were accepted by publishing houses, which is no longer the case. You can now self-publish a book with Kindle, Barnes & Noble, Nook, etc. The options for self-publishing are getting better and better with each passing day. You can also create blogs with the information you wish to share with others and monetize them. Once the blog is in place, you will be required to spend some time developing links to it so that Google can find it. After that, your blog or website will keep generating a steady trickle of advertisement and referral revenue. Investing money. If you have money to invest, then you can simply invest that money into generating passive income for you. You can consider some of the following paper assets to generate passive income. Dividend-bearing stocks. If you buy, let us say, $20,000 worth of Coca-Cola shares, then you will be entitled to receive regular dividend payments that will give you passive income. Over a period, your stock will multiply and gain in value, increasing your dividend payments. You should choose a very stable company that pays out a very steady dividend. This type of approach can earn a very reliable income for you. You might also want to invest in mutual funds that are indexed to spread out your investments over a large number of stocks, less risk. I will cover more of this strategy later in the course. Treasury inflation-protected securities, or TIPS, are bonds that you can purchase from the government whose face value adjusts according to the rate of interest, so that when the TIPS mature, you will be able to sell it for more than the initial purchase price. TIPS return is at a very low rate, but they have the advantage of being rock-solid investments that will match inflation growth when you sell them. Savings accounts and CDs are similar rock-solid investments. They are also very liquid, meaning you can cash out your money whenever you need it. The interest rates are generally on the lower side. There are, however, times when a savings account or CD is very solid. Annuities are investments you can purchase from an insurance company that will pay you a certain amount of residual income every year for the rest of your life. The younger you are, the smaller will be your contribution. Let's say, for example, that you purchase a $30,000 annuity, one that the insurance house quotes at 4%. It would mean that you would receive $1,200 each year for the rest of your life from that company. The risk you have here is that the insurance company may eventually become insolvent, leaving you with nothing at all. You must therefore seek out an insurance company with a long history of stability and good bond rating. You must also diversify across multiple insurance houses. Categories of residual income. For a clearer understanding, we can divide residual income into two broad categories. Residual income sources that require startup capital or additional funds to maintain and grow. Residual income sources that require little or no startup capital or maintenance money. The first category will need initial capital from your earned income, family money, funds from investors, or borrowed funds from banks to purchase assets that will generate passive income for you. When you borrow money, you create debt, which provides you leverage to create accelerated wealth. But it also comes with associated risks that can destroy your wealth. Examples of this type of residual income will be investing in stocks and other paper assets, real estate investments, or buying businesses that have systems in place that need very little of your personal time to run the company. Another example would be that of a good franchise business, like McDonald's. It has systems in place and will need very little intervention on your part. The second category of residual income requires very little financial outlay and is generated through assets that you create by writing a book, song, software, patent, or trademark. The internet has provided a new medium to generate residual wealth through creation of virtual real estate. Virtual real estate is the new gold rush, and without a doubt, it is the new frontier that you have to master to create residual income. The internet is creating new millionaires every minute, even as you hear this book. What is virtual real estate? These are the assets you create on the internet. These include your websites, domain names, email lists, online businesses, Facebook, Twitter, and other social media accounts. Once you create these assets, you can generate residual income from them for years. We will discuss this at greater length. You can further categorize residual income into offline residual income, online residual income. Offline residual income generally requires more capital. You can take advantage of a variety of financial advisors and products to start investing in residual income investment schemes, like paper assets and real estate. You can also get bank funding for buying these assets, and hence can leverage your time and money. On the other hand, online residual income, or creation of virtual real estate, requires very little, and in some cases, no startup capital. There are many online gurus, but no financial advisors. Banks will not fund it because the risks are too high. It is a new frontier of wealth creation that is still in progression. It is still the Wild West out there. You have to make the effort to increase your knowledge to create wealth in this new environment. There are many scam artists who will make you part with your hard-earned money on the internet. You have to be extremely careful before pulling your credit card out of your wallet. There are risks, but very high rewards as well. Opportunities are endless. If you make the effort of mastering the new environment, you can create large amounts of residual income with very little effort in the shortest possible time frame. Creating residual income on the internet does not give you financial leverage, but technological leverage. Financial leverage creates debt with associated risks. Technological leverage, on the other hand, is debt-free and faster. The best instrument to be used to create residual income will depend upon your financial situation, time availability, and state of knowledge at a given point. If you have plenty of capital and cash flow from your job or business, but no time, then it will be better for you to employ services of a professional financial advisor to invest in offline assets such as real estate, stocks, bonds, CDs, commodities like gold, silver, etc. Alternatively, if you are internet savvy with little or no capital, then creating a virtual real estate to generate residual income may be the right choice for you. You have to also take into account your risk appetite for a particular type of investment. Your assessment of your situation is the key to making a successful choice. Steps to create residual income. In most cases, people start out in jobs as their primary source of income. You have to start using a part of your actively earned income into generating passive income on a regular basis. You will be surprised at how fast your residual income will grow if you start out early. Your investments will multiply if you apply the power of compounding properly. $1 a day, if invested correctly, will make you a millionaire before you retire. If you are new to the stocks and mutual funds, then I advise you to go for investing in indexed funds using dollar cost averaging. This strategy gives the highest returns with a minimum amount of risk. Let me explain. Indexed funds. Indexed funds are a type of mutual fund with a portfolio constructed to match or track the components of a market index, such as the Standard & Poor's 500 Index or S&P 500. An index mutual fund provides broad market exposure and low operating expenses, as no fund manager is involved. The lack of active management generally gives the advantage of lower fees and lower taxes in taxable accounts. This increases your returns as an investor. It has been found that indexed funds outperform funds managed by fund managers, as there is no human intervention and mistakes. Dollar cost averaging. This technique involves buying a fixed dollar amount of a particular investment on a regular schedule, regardless of the share price. More shares are purchased when prices are low, and fewer shares are bought when prices are high. Eventually, the average cost per share of the security will become smaller and smaller. Dollar cost averaging lessens the risk of investing a large amount in a single investment at the wrong time. No financial expert has been able to predict the behavior of the stock market accurately. Dollar cost averaging will reduce your risk considerably. In dollar cost averaging, you will need to decide on 3 parameters: the fixed amount of money invested each time, the investment frequency, and the time horizon over which all of the investments are made. The longer the time horizons, the better are the results. The minimum recommended period is 12 months. The best way to start building residual income is to combine investing in indexed mutual funds using dollar cost averaging strategy. This way you will get the highest returns with minimum risk. Many fund managers will advise you against this strategy because they do not benefit from it. Take the human element out of investing. Let the market magic work. It has shown time and again that index funds beat the performance of most fund managers. The exception to this rule is Warren Buffett. If you can find a fund manager backed with 20 years track record of beating the market, then go for it. I am yet to find one.